Welcome to Wealth Mavericks, the podcast where we help doctors uncover the secrets to building generational wealth. And today we're talking about a question that comes up all the time, and that is, what are the steps I can take as a doctor to minimize my risk of an audit?
You've got to learn how to work with the IRS as your business partner.
Yes.
If you're not in business, they are not your partner. They're just an organization that's designed to take from you. It really is the way it is. And so when you learn to adhere to the principles that we espouse at Terra Firma, it is learn how to use the IRS as an effective business partner.
So we have a saying in our practice, income is taxable, cash flow is plannable. That business revenue is cash flow. We get to plan it.
So Bob, I'm having so many conversations with doctors and a lot of different questions come up. But the one that seems to come up in nearly every conversation I'm having is the audit question.
Mm-hmm.
Everyone is afraid of getting audited and they are wondering, well, if I put these tax saving strategies in place and I lower my liability at the end of the year significantly, am I going to raise my risk of an audit? So I would like to talk about that today.
Yeah, no, it's a great question. And a lot of that has to do with because the not having the knowledge of how actually the tax code and the financial statements, meaning the tax return, works. Right. So really, if you just take a step back and say, okay, how's the tax code written? It's written for business owners. Okay. So if I'm a W-2 employee doctor and I'm making $650 a year, you don't have a lot of tax strategies available to you on purpose. That's the way the tax code's written. It's not written for you as an employee. It's written for you as a business owner. Why? Because as a business owner, if you can reduce your tax liability, you have more cash, you can put it into your business, grow your business, hire more employees, which is what you are as a W-2 doctor, right? So both business owner and W-2 doctors really need to have a business. Well, right off the bat, the W-2 employee doctor is going to say, well, I don't want to run a business. You misunderstand what having a business means. We're not saying quit your job to become a in-practice doctor running your own business. Businesses are all different. So here's why I'm bringing this up, is that when you look at the IRS comes out with a data book, and the data book explains how many phone calls they received that year, how many tax returns they've done, audits that they're working on, what they call them. So they discuss how many audits are occurring. And here's the interesting thing. They do it based on income level, not the tax bracket level, but income levels, ranges of let's say 20 to 50,000 in a year in income. And then they show, you realize how many audits actually happen with people that are making 250,000 and more is less than people making 250,000 less. Why do you think that is? It's because of the tax return and the algorithms in the tax return, that those that are at 250 or less are trying to deduct things that are not allowable on a Schedule C, which is the business return on the 1040 tax return. Okay. Now this is very important. So that means statistically speaking, there are more audits due to the Schedule C, but what does the IRS audit? A individual taxpayer at 1040. What's part of that? The Schedule C. Now they're trying to write off their home office. They're trying to write off mileage. They're trying to write off meals. And a lot of times those people are doing their taxes on their own. The IRS knows that. That does not meet any of our doctors already. Right? And so, but they hear that. And guess what? They're working with a tax preparation person, maybe a CPA, who also has clients in that tax bracket, those income ranges. They're not just focusing on just doctors. They're not just focusing on high income earners. They work with everybody under the sun. We don't. We focus specifically on doctors. and high income earners, because we understand how the IRS tax code is written for you to be able to reduce your taxes. So if you know that basic part of it, then you know, okay, so my audit risk already statistically speaking is lower. Okay.
Well, hold on. What do you mean already is lower? Because I think people don't understand what you're saying.
Because you're making more money. Because you're making more money.
Okay.
Most of the audits occur on lower income ranges, because those are people who are trying to find deductions or making up deductions on their tax return, doing it themselves, doing it improperly and incorrectly. Okay. And so when you have CPAs who are going to courses and doing all this kind of stuff, they're not learning about the tax code. They're learning about all the things and compliance issues that cause audits. Well, they don't segment those clients off to the side with their high income clients, their business owner clients. They just lump them all in. They treat them all the same. Why? Because they all file 1040s. Everybody files an individual tax return, whether you're a business owner or not, right? Mm-hmm. So there's a difference though. And that's why we focus on physicians. That's why we focus on high income earners, because there is a difference. There's a different use of the tax code. You get more access to it. Even if you're a W-2 employee earning $650, you get more access to the tax code. You just need to know what to do to have access to it. It's like finding a key, the combination to a lock. Not everybody has it.
Yeah. And so what I'm hearing though is you're more likely to be audited if you are a, sole proprietor, you are not earning a huge amount in your business, but you're doing okay and you're writing these things off. And we're then telling these high W-2 earners that, well, we're going to make you into a business owner so that you can shift some of those personal expenses and lower your tax liability. So, if I'm just learning this for the first time, am I thinking, okay, well then by shifting me, are you then increasing my risk of audit? Does that make sense?
No, actually it's decreasing.
Okay.
And the reason why it's decreasing is because you're utilizing your money, your funds into other business activities. Now, here's the key. You need to, when you set up a business, and we go through all this and do the compliance and all the documentation and everything for our members to be able to understand the basics of how to do all this. Okay. But when you let's just use numbers as an example. Is that okay?
Yeah.
Okay. So let's say we work with a doctor, makes $650 a year. They have a brokerage account or a savings account with, let's say $300,000 in cash, right? Doesn't matter where it's in. It's just cash, liquid. And they have a medical license. Whose medical license is it? It's theirs. It's not the hospital they work for. It's theirs. So they have an inherent risk for their medical license, and they have the inherent responsibility of keeping their medical license up. They don't have to, the hospital doesn't have to do something for that doctor to keep their medical license. The doctor has to do it. Just like me with my securities license and my life insurance license. I have to renew it. I have to keep it up. Mm-hmm. Nobody else is responsible for that other than me. Okay. So let's say you have 300,000. What's the difference between 300,000 sitting in your savings account and 300,000 sitting in a savings account in a business? Let's just call it Dr. LLC. Mm-hmm. And we design it as a holding company or management company, something to that effect, right? Well, it doesn't matter. It's an LLC and you're married and we set it up as taxed as a partnership or as an S corp. Doesn't matter. But we have that separate entity. Okay. What's the difference between that 300,000 sitting in your bank account and personally and the 300,000 sitting in your business account? Well, first of all, the difference is that when you earn interest on this, you're going to get a 1099. It's going to be taxable income. Let's say you get a 1099 on that interest earned in the business account. What happens? It's revenue. What do you get to do with revenue in a business? Well, you have expenses to run a business, right? The setting up of the business. When you get the tax returns done, you have an expense to that, right? If you're doing stuff at home, your cell phone, as a doctor, you work on your cell phone, right? All the time. Your internet at home, are you on call? And do you do telemed at home? Guess what? That fits in that category. You have a separate room that has a closed door. Doesn't matter how big it is, but it's a separate room that you do telemed, or you take on call clients to see if you need to go down the street to the hospital, or you can just answer the questions there. That's all work related. That is related to that medical license you have. Those are expenses. Can you take those expenses on your savings account? No, you can't take them on your savings account. Can you do it on the Schedule C? You kind of could, but then you go back to that question. Well, we're increasing our audit risk now. Right? So we set this up in a business side. And then what do we do with that 300,000? The same reason why you had it in your savings account was, well, we're thinking about investing in real estate. We're not sure how we want to do it, but we've talked about it. And some of the doctors in the cafeteria have talked about some of the deals they've gone into. So my wife and I were just trying to figure that out. Well, can you figure it out over here too? Absolutely. Same 300,000. So could you buy that real estate in the name of the LLC? And then the revenue from that LLC, that real estate, the income from that goes to the LLC, and it's revenue. If it comes to you, it's income. So we have a saying in our practice called, we say, income is taxable, cash flow is plannable. That business revenue is cash flow. We get to plan it. Okay. And so that is an area. And so now when you have a separate business, you have a separate bank account, we do separate books, you have a separate tax return that is connected to your personal return on the Schedule E, which is for real estate and businesses. Okay. So that's how it still all flows to your first page, and it all comes to your taxable income, but it's on a different schedule. It's on a business schedule because you're telling the IRS on the Schedule E, I have separate businesses. Now, if you're running it as a sole proprietor, to your point earlier, Aaron, it's on the Schedule C. You're saying I am self-employed and I'm taking income separately. That's a higher risk statistically. Okay. So it's just knowing how that money flows and how the IRS views it. Okay. Now, is there a guarantee to not get audited? Of course not. There is no guarantees. But if you're doing everything right based on how the IRS code, as well as the legal laws that go with those codes, you're doing everything that you're supposed to be doing, why can't you? Well, what if my tax rate goes from, I'm paying 90,000 in taxes, now I'm paying 30,000 in taxes. Well, if you've got some things on the Schedule E, guess what? They know where that money went. Yeah. They know why it went down by 60 grand. Because you're also filing a tax return.
Yeah, that's something I hear a lot. Like, okay, you're showing me that, okay, I paid this last year, and if we implement your strategies, I'll pay this year. The difference is very dramatic. Isn't that going to be a red flag to the IRS? But that goes to another question. It's like, what do we do to prevent it? And it's all back to documentation and showing what we did and why we did it, right?
Right. Absolutely. Because when you set up your business entity, if you looked at what the IRS says, is that you get to set up this business entity. By the way, setting up a business entity is not for tax purposes. It's for liability protection purposes. It's a legal purpose. But you also have the benefit to get tax benefits as long as you agree to keeping separate books, bank account, and keeping your financials separate. Okay. So that's what? Documentation. When we file our personal tax return, does the government ask us for our budget? No. They do on our business, which is our financial statements, which flows down to our tax return. Why do they do that? Because they're giving you better tax benefits. If they're going to give, you got to give. It's a relationship. It's not a take, and that's the problem. A lot of times people want to take because they don't want to give to the IRS. No, you need to leave meat on the bone for the dog. You starve a dog, the next time you go out there, they will bite you. And there's no need for that.
I think there's really, really important principles that you're talking about here, Bob, because most high income, I'll call it like W-2 high income earners, only view the IRS as the enemy.
Yeah.
It is the enemy stealing from me. This is where that taxation is theft concept comes from. It's like, and it very much feels that way. We've talked to people who've literally called it slavery. Like, that's slavery. I'm working for the government for greater than 50% of my year. That's not right.
Yeah.
But what you have expressed, and we've talked about this in other episodes, you've got to learn how to work with the IRS as your business partner.
Yes.
If you're not in business, they are not your partner.
Yeah.
They're just an organization that's designed to take from you. It really is the way it is.
Mm-hmm.
And so when you learn to adhere to the principles that we espouse at Terra Firma, it is learn how to use the IRS as an effective business partner. Exactly what you just said. They're going to give you a lot, and they do expect something in return.
Absolutely.
You've got to have accurate financials. So what I'd hate for some doctor who's earning a bunch of money who like listens to this episode and goes, oh, I'm going to go on LegalZoom, I'm going to set up an entity and I'm just going to go do this. And it's like, you can do that, and you better do it right. And that's the thing, is because you do, and Bobby, you brought this up earlier, I'd be curious to hear your take on this. And Aaron said it, but I wasn't satisfied with the answer. So you started off by saying the lower the income shown, the greater the risk of audit. We're going to show you how to lower your income. You're going to fall into that category where there is a greater risk of audit. So maybe if you can help give me a satisfactory answer to that, because it sounds like you're saying two things.
Yeah. So that means we need to take a step back and see what kind of incomes there are that the IRS taxes. Right? There's different buckets. So when you think about, when you've ever heard the government talk about taxes and tax revenue, most of the time they're talking about payroll taxes. And they'll say that, right? Payrolls are, when they do reporting on a quarterly basis, right? Jobs and unemployment and payrolls have increased. Why do they do that? Well, that's the cash flow. That's the tax revenue the government focuses on. Just like you as a W-2 earner. When you're budgeting yourself, you're looking at your income net income that you're bringing in, right? And your credit standing is based on that income and your debt. The government's credit rating is based on the income revenue and their debt. The difference, though, they can manipulate their income and debt because they work with the central bank, their Federal Reserve. You cannot. For you, it's fraud. For them, it's planning.
Right.
This is why laws and regulations is one of our economic termites in my book, right? They change the rules as we play the game, right? And it's not fair. And that's what a lot of times CPAs project that fear onto their clients. Right. And so the clients say, well, my CPA is saying this, then it must be real. And you hear it enough, you embody it. Right? Yeah. It's like, don't cross the street without looking both ways. Why?
So really, what you're saying is it depends on the type of income. Yeah. And I think something to alleviate people's minds, and you shared this with me, Bob, because I think, for most of us, we are the center of our universe. Right? I mean, it's like the universe moves around us. It's the only experience we have. It's understandable why we think that. Yeah. So we think, oh, if I reduce my taxes that I pay from $200,000 a year to $20,000 a year, the IRS is going to notice this and they're going to come knock on my door and they're going to start asking questions. And your point that you brought up to me that I think is really important is you're just not that important. They don't care. I mean, $1 million is their rounding error. So you reducing your taxes, legitimately doing it the right way. We're not saying you cannot and should not be fraudulent. That is bad, right? Mm-hmm. But reducing your tax exposure, not so that you can go buy a boat or a nicer car, but like actually invest in your future, that is beneficial to the government. Because that's one less person, one less mouth they've got to feed down the road because you're taking care of yourself. Mm-hmm. So I think that concept that and maybe you could talk for a moment about that, but it's like, you think that you're such a big deal. They don't care.
Yeah, they don't care. And they're very specific about it too when they talk, right? When they got all that $80 billion funding to increase the audit agents and all this kind of stuff, what did they kept talking about? People making over $400,000 a year, right? What are they talking about? The last few months, they came out with, we were able to recover X amount of billions over the next 10 years. Everything's based on 10 years, by the way. Who does 10-year planning? None of us. They do it to impress us. No. Anyways, that's a different rabbit hole. Sorry.
Wait, so I think what I heard you say is we spend $80 billion so that we could recapture a couple billion. That's correct. Government spending.
Currently, but they tell us over 10 years, this is what we plan on recovering.
Right.
Okay. But inflation's 9% or 15%, depending on how you want to talk. I know they say 3%, but we all know it's different, right? We all know it's higher. So yeah, in 10 years, that 80 billion is going to be worth what? 60? But anyway,
Right.
different rabbit hole also. So here's the interesting thing about that is that you are absolutely right. They round to the millionth. The millionth. Okay. And so you are important to people like us, but not to people on the top level. So they're auditing the big guys because they're trying to recover hundreds of millions of dollars in taxes, billions of dollars, not the taxes. What their rate of return on taxes is the penalties and interest. That's how they make money on dollars. You make money on dollars by putting it into other assets like real estate, the stock market, or CDs, or whatever it is. They make money by recouping penalties and interest on past years until it gets paid. That's how the government makes money on money. Okay. And so that's what we got to understand. And so when we're here in the lower level, but here's the other thing. If you're in the W-2 category or you're a practice business owner, on the practice business owner side, we can control your income based on your expenses, and we justify your income with documentation and methodologies proven and supported by IRS court cases. Okay. So what are we saying? Documentation. Okay. If you're a W-2 employee, I can't control your income. Congratulations. You negotiated a $650,000 salary. You're well worth it. You have an expertise that saves lives. There's your dollars. I can't control that. What I can control is the next step of how do we lower the taxable liability by saying some of this 650, we're going to build assets, not personally, but through a business that we've established that creates revenue. Semantics are extremely important when it comes to taxes, law, and insurance. Words mean everything. And in medical field, it does as well. They're just all Latin. None of us can pronounce them but you. Right? So it's very important to understand that. Now, if you are a doctor, and we can probably talk about 5 hours on this, and I can definitely do that with the same energy, if not more.
Might be a two-parter.
I'm like trying to crawl into the camera right now. It's like too small.
Yeah, I'm like, we can control the income, or we can control cash flow, but we can't control Bob's volume because it's loud.
That's right. They keep lowering. Man, this guy is obnoxious. But this is the exciting thing, is that once you know the rules to a game, it's like, oh my goodness, now I know what I get to do. Isn't that much easier? Now you know where to put your energy. But if you always go around not understanding the rules or how to play a game, you're kind of wandering around looking, and you're going to get hit. You're going to get ran over by somebody or something because you're in the wrong spot. But once you have that confidence of knowledge, and then we implement that knowledge into reality, now you get to feel that knowledge, experience it, and then your velocity of money, your rate of return on the value of your revenue increases.
Right.
That's what we want.
And that's, I know we want to wrap up this episode. I think Aaron's like chomping at the bit to close this one down because we don't want it to be too long. But I think that concept of $1 saved in taxes is an immediate guaranteed return on investment. Whatever your tax rate that you pay is, that is a return on that dollar saved. People I don't think really understand that. They like do everything they can, and they get, these dumb doctor deals that we've talked about before. You get promised this thing, this rate of return, whatever it might be, and maybe it's a 15% rate of return. You're so excited about that, and you've got 100% risk with that investment, whatever it might be. But with $1 saved in taxes, you immediately have whatever your effective or whatever your marginal tax rate is at that point. That's a guaranteed return immediately, not down the road. It's guaranteed and it's immediate. So I think just understanding things from a larger perspective, and if we're wrapping up this episode, this concept of how do I minimize my risk as a high income doctor, you kind of move those expenses from Schedule C on your 1040 to a business return. And there's really simple steps that you can take to make that happen. So Hopefully people who are listening, hopefully they're already members and we're already taking care of this stuff for them. But if you're not a member and you're a doctor and you're making $650,000 a year and you fit this demographic that we just talked through, you are why we created Terra Firma. You are why we created this membership program. There is no logical reason that I can see why you haven't engaged with us. So we look forward to serving you.
Yes, I love Bob's passion when he talks about this. And I think we could do a follow-up episode on, okay, you've told me that my risk of audit is quite low. Like, we fear it, but it's very, it's probably not going to happen. But we could do an episode on, well, what if it does happen? What does that look like? All I'll say now is, like, we've got your back. But we could probably talk more about that. Doc, we hope we've given you some peace of mind when it comes to the question, will I get audited if I lower my taxes? And we invite you to reach out to us if you're ready to do something about that high tax bill. You can find us online, on social media, on LinkedIn, and we look forward to talking to you. And until next time, go be a wealth maverick.